There are moments in history when markets stop behaving like markets and begin behaving like warnings. You are witnessing one of those moments right now. The first week of February 2026 has delivered a sequence of price movements that should not be happening under normal economic conditions. Gold has surged toward the $5,000 threshold again. Silver has swung violently between euphoric rallies and sharp liquidations. And companies that depend on silver for industrial production are scrambling to redesign entire supply chains just to survive the cost shock. This is not volatility in the traditional sense. This is stress, structural stress, monetary stress, the kind of stress that builds quietly for years and then erupts in waves that feel random to the untrained eye, but are, in fact, the predictable consequence of a system pushed too far. And now we need to talk about the signal that almost nobody is interpreting correctly. Silver is not just rising, silver is screaming, because silver is the metal that sits at the intersection of two collapsing realities, industrial demand and monetary distrust. When both forces move at once, the result is not a rally, it is a warning. The first signal is speed. Over the past year, silver has surged dramatically, at times exceeding $100 per ounce before violent corrections. The second signal is instability. Analysts are openly acknowledging that silver's dual role as both an industrial metal and a monetary asset is producing unprecedented volatility. The third signal is structural. Global supply deficits in silver are now entering multiple consecutive years, driven by relentless demand from solar energy, electrification, and electronics. These are not isolated data points. Together, they form a pattern. Now we need to talk about the broken signal, the anomaly that reveals the deeper truth. In a functioning financial system, rising interest rates, a stabilizing dollar, and tightening liquidity should suppress precious metals. That is the rule. That is the textbook model. But that rule is breaking in real time. Gold is rising while debt levels surge to historic highs. Stocks continue to climb in many regions, even as geopolitical fragmentation intensifies. Central banks are accumulating gold at one of the fastest paces in modern history, absorbing a significant share of global mine supply. When central banks themselves begin to treat currency reserves as liabilities rather than assets, the message is unmistakable. Trust is eroding. And this brings us to the most dangerous signal of all, the divergence between paper confidence and physical reality. Silver's price movements are being driven not only by speculation, but by genuine shortages in physical supply chains. Solar manufacturing, electric vehicles, and industrial electrification are consuming silver at a pace mining production cannot easily replace. This is where the system begins to fracture. Because financial markets can create paper contracts indefinitely, but they cannot print atoms. And when the gap between paper supply and physical availability widens, price behavior becomes erratic, violent, and psychologically destabilizing. Now we need to talk about the real cause, the mechanism operating beneath the surface that explains everything you are seeing. The world is drowning in debt. Global sovereign debt, corporate leverage, and household liabilities have reached levels that cannot be repaid in real terms without triggering systemic collapse. The only viable response available to policymakers is currency debasement through liquidity expansion, rate suppression, and balance sheet intervention. This is not theory, this is policy. Central banks continue to purchase gold aggressively, with expectations of hundreds of tons in annual demand continuing into 2026. Why would institutions that issue currency accumulate metal that yields nothing? Because they understand something that most investors do not. Assets are not rising, currency is falling, and once you see this, the entire financial landscape changes. This brings us to global confirmation, the evidence that the warning is not local or temporary, but systemic. Across emerging markets, citizens are turning to gold and silver not as investments, but as survival tools. In countries facing banking instability and inflation crises, precious metals are becoming parallel currencies, a last line of defense against institutional failure. Meanwhile, geopolitical fragmentation is accelerating what some analysts describe as a coming capital war, a period in which nations weaponize trade, reserves, and financial flows against one another. This is not a theoretical risk. It is already happening. Trade restrictions, export controls, reserve diversification, sanctions. Each of these forces reduces liquidity, fractures supply chains, and drives nations toward hard assets that cannot be frozen or digitally erased. And this is where silver becomes uniquely important. Unlike gold, silver is consumed. It disappears into circuits, panels, and industrial components. It is not just stored, it is used. That means shortages are not merely possible. They are inevitable under certain demand conditions. Now we need to talk about the contradiction, the lagging signal that reveals the psychology of this moment. If precious metals are signaling monetary stress, why do many investors still cling to cash as if it were stability itself? Because cash feels safe. It is liquid. It is familiar. It is immediate. But cash is also a melting asset in an inflationary regime, especially when real interest rates fail to compensate for currency dilution. Inflation expectations, real yields, and monetary expansion remain the core drivers of gold and silver prices, and these forces have not disappeared. The illusion of stability is powerful, but illusions do not stop systemic change. This brings us to the final verdict. We are not witnessing a commodity cycle. We are witnessing a regime change. The post-1971 monetary order, built on fiat expansion and debt-driven growth, is approaching its structural limits. Historical analogies from the 1970s show that precious metals can enter multi-year supercycles when inflation, geopolitical stress, and monetary expansion converge. And yet, what makes this moment different is scale. Debt levels are higher than ever before. Supply chains are more fragile. Geopolitical divisions are deeper. Financial markets are faster, more leveraged, and more interconnected. When a system this large begins to destabilize, the consequences do not unfold slowly. They unfold suddenly. Time itself becomes the enemy. Settlement times matter. Liquidity windows matter. Market closures matter. Because in a crisis, price does not move in orderly increments. It gaps. And silver, with its smaller market size and industrial exposure, becomes the most sensitive seismograph of monetary stress in the entire financial system. The warning signals are already visible. Extreme volatility, structural deficits, industrial shortages, central bank accumulation of alternative reserves, nations preparing for financial conflict. These are not random events. They are fragments of a single story, a story about the end of one era and the uncertain beginning of another, and whether most people realize it or not, they are living inside that transition right now.